NVIDIA's silver problem, why AI needs 3.5 times more, and why the price must hit $150. Everyone's buying NVIDIA stock. Everyone's pouring billions into AI. But there's something they're not telling you. A hidden bottleneck, a physical constraint, that's about to detonate the entire artificial intelligence revolution. It's not about chips. It's not about software. It's not even about electricity. It's about a metal that cannot be substituted, a metal the world is running out of. Right now, in real time, while tech giants are building data centers that need 3.5 times more of it, and the supply, it's collapsing. Welcome, my friend, to Currency Archive. You know, I've been doing this for a long time now, and I've learned that the smartest people, the ones who see what's coming before the crowd does, they're the ones who take just 2 seconds to hit that subscribe button. So do me a favor, will you? Click subscribe right there below this video, because what I'm about to share with you today, you won't hear anywhere else. And before we dive deep into this silver crisis, tell me in the comments, where in the world are you watching this from? Are you in the States, Europe, Asia, South America? I want to know, because this story, it affects every corner of the globe. Now, let's talk about what's really happening. While the world watches NVIDIA's stock price climb and technology executives announce billion-dollar AI investments, a different story is unfolding in the background. It is a story about physical reality colliding with digital ambition, and most people have no idea it is happening. In 2026, the artificial intelligence industry is consuming resources at a rate that would have seemed impossible just 3 years ago. Amazon is building data centers. Google is building data centers. Microsoft is building data centers. Meta is building data centers. Every major technology company on Earth is racing to construct the physical infrastructure needed to power their AI ambitions. But there is a problem that cannot be solved with more investment capital, a problem that cannot be fixed with better software, a problem rooted in the laws of physics and the limitations of the Earth itself. Each new AI data center requires something specific, something that traditional cloud computing facilities did not need in such large quantities. That something is silver. The numbers tell a stark story. A traditional server rack, the kind that has powered cloud computing for the past decade, requires a certain amount of silver for its circuit boards, connectors, and cooling systems. These new AI servers, specifically designed to handle the massive computational demands of machine learning and large language models, require 3.5 times more silver than their predecessors. Not 10% more, not 50% more, 3.5 times more. This is not a small adjustment. This is a fundamental multiplication of demand hitting the global silver market in real time. And it is happening while the world is already facing a supply crisis that most investors do not yet understand. For 6 consecutive years, the global silver market has operated in deficit. This means the mining industry has been producing less silver than the world consumes every single year. The gap is not small. It is approximately 67 million ounces annually. That is 67 million ounces of silver that must come from somewhere other than new production. Where does it come from? Existing stockpiles, warehouse inventories, recycled materials. But these sources are not infinite. They are being drawn down, month after month, year after year. Meanwhile, NVIDIA reported that its data center revenue grew by billions of dollars in recent quarters. Each percentage point of that growth translates into physical servers being manufactured. Each server contains silver, lots of it, and the orders keep coming. The hyperscalers, as the largest technology companies are known in the industry, have committed over $200 billion to AI infrastructure spending in 2026 alone. This is not speculation. This is announced capital expenditure, money that is already allocated, projects that are already underway. Every one of these projects requires silver, not as a luxury component, not as an optional upgrade, as a fundamental necessity for the hardware to function at the performance levels required by modern AI workloads. The financial markets have priced in NVIDIA's growth. They have priced in the AI revolution. They have priced in the software applications and the productivity gains. But they have not priced in the physical bottleneck that is forming in the supply chain of one of the most critical materials in the entire technology stack. Silver sits at approximately $32 per ounce as of early 2026. This price reflects traditional industrial demand, it reflects jewelry demand, it reflects investment demand from people buying coins and bars, but it does not yet reflect what is coming. It does not reflect the reality that AI infrastructure is not slowing down. It is accelerating. It does not reflect the fact that every major economy is now viewing AI capability as a matter of national security. It does not reflect the billions of dollars already committed to projects that will require hundreds of millions of ounces of silver over the next 36 months. The disconnect between current silver prices and the coming demand surge represents something significant. It represents a market that has not yet recognized what is happening, a market that is still operating on old assumptions about supply and demand dynamics that no longer apply. This is the invisible crisis, the physical constraint that nobody is discussing while they debate which AI company will dominate the future. Because the future they are building requires a metal that the Earth is not producing fast enough to meet their needs, and that changes everything. There are moments in industrial history when engineers discover that certain laws of nature cannot be negotiated with. This is one of those moments. Silver is not valuable in AI infrastructure because of tradition. It is not used because manufacturers prefer it aesthetically. Silver occupies a position in these systems that no other element on the periodic table can replicate. The reasons are embedded in the fundamental physics of how electricity and heat behave in matter. When electricity flows through a conductor, it encounters resistance. This resistance generates heat. In most applications, this is merely an inefficiency. In AI data centers running NVIDIA's H100 or H200 GPU clusters, this becomes an existential engineering challenge. A single modern AI training server can draw 200 kilowatts of continuous power. To put this in perspective, the average American household uses approximately 1 kilowatt. These servers are operating at power densities that approach industrial furnaces. The chips inside are performing trillions of calculations per second, and every calculation generates heat. Silver is the most electrically conductive metal that exists in nature. It moves electrons with less resistance than any alternative. Copper is second, gold is third, but the gap between silver and copper is not marginal. Silver conducts electricity approximately 6% better than copper. In high-performance computing, that 6% is the difference between a system that works and a system that fails. But electrical conductivity is only half of the equation. Silver is also the most thermally conductive metal available. It transfers heat faster than any other element. When a GPU is generating enough heat to damage itself within seconds if cooling fails, thermal conductivity is not a feature. It is survival. Engineers have tried alternatives. The semiconductor industry has spent decades attempting to reduce silver content in circuit boards and connectors. Copper is cheaper, aluminum is abundant, gold is more corrosion resistant. Every major electronics manufacturer has experimented with substitution strategies. They all came back to silver. The reason is straightforward. When power density increases, material science stops being about cost optimization and starts being about physical limits. AI chips operate at frequencies and power levels where even small increases in electrical resistance cause catastrophic failures. The heat must be removed instantly. The current must flow without impediment. There's no room for compromise. NVIDIA's latest GPU architecture represents a case study in this constraint. The H200 chip contains over 80 billion transistors. It consumes up to 700 watts under full load. The cooling systems required to keep this chip operational depend on silver-based thermal interfaces and silver-enriched solder connections throughout the power delivery network. These are not decorative applications. These are critical path components. If the silver is removed or substituted with inferior conductors, the chip overheats. If the chip overheats, it throttles performance. If it throttles performance, the entire business case for AI infrastructure collapses. This creates an unusual situation in commodity markets. Usually, when the price of a raw material rises, manufacturers find alternatives. They redesign products. They substitute cheaper inputs. Economic incentives drive innovation toward cost reduction. Silver in AI infrastructure does not follow this pattern. The physics does not allow for substitution. A data center operator cannot choose to use less silver the way an automobile manufacturer might choose to use less steel. The silver content is determined by engineering requirements, not by procurement preferences. Industry research teams have explored exotic materials. Graphene-based conductors showed promise in laboratory conditions, but failed in manufacturing at scale. Carbon nanotubes offered theoretical advantages, but could not be produced with sufficient purity or consistency. Specialized alloys were tested and rejected because they introduced variables that could not be controlled in high-volume production environments. The conclusion reached by materials scientists across the semiconductor industry is consistent. For the foreseeable future, there is no viable alternative to silver in high-performance computing applications, where both electrical and thermal conductivity are critical. This matters because it transforms silver from a commodity with elastic demand into a commodity with inelastic demand. In economic terms, the AI industry must have silver regardless of price. The amount required is determined by technical specifications, not by budget constraints. When Google commits to building an AI data center, the silver requirement is fixed. When Microsoft orders 10,000 GPU servers, the silver content per server cannot be reduced. When Amazon expands its machine learning infrastructure, the material inputs are non-negotiable. This is the physics of constraint, not a temporary shortage that can be managed through clever engineering, not a supply chain disruption that resolves itself when logistics improve. This is a fundamental requirement that cannot be eliminated, reduced, or substituted, and it is hitting the global silver market at exactly the moment when that market is least prepared to absorb it. Mining silver is not like mining copper or iron. The economics are different. The geology is different. And the timeline to respond to sudden demand shifts operates on a scale that most people outside the industry do not understand. There's a number that keeps appearing in mining industry reports. It is 67 million ounces. This is the annual deficit between what the world produces and what the world consumes. Every year for the past 6 years, humanity has used 67 million more ounces of silver than miners extracted from the ground. At first glance, this might seem manageable. Markets adjust, producers increase output, supply eventually meets demand, but silver does not work that way. Approximately 70% of all silver mined globally is not mined for silver. It is a byproduct. When companies dig for zinc, they find silver. When they extract lead, silver comes along. When they mine copper, silver appears in the ore. Only 30% of global silver production comes from primary silver mines, where silver is the main objective. This creates a structural problem. When silver prices rise, zinc miners do not increase production. Lead miners do not expand operations. They are optimizing for their primary metal. The silver is incidental. A price signal that would normally trigger production increases in other commodities has a muted effect on silver supply. Even primary silver miners face constraints that make rapid expansion nearly impossible. The average time from discovering a silver deposit to producing the first ounce of refined metal is 7 to 10 years. This includes exploration, feasibility studies, permitting, financing, construction, and commissioning. 7 to 10 years. The AI infrastructure boom demanding 350% more silver per server is happening now, in 2026, not in 2033. There's another complication buried in the geology itself. Silver ore grades have been declining for 2 decades. In the 1990s, a typical primary silver mine might extract ore containing 12 ounces of silver per ton of rock. Today, that figure is closer to 6 ounces per ton. Miners are digging up twice as much rock to produce the same amount of silver. Lower ore grades mean higher costs, more energy expenditure, more processing, more waste rock, more environmental impact, and crucially, less profit margin at current prices. At $32 per ounce, many potential silver projects are not economically viable. The capital required to build a new mine cannot be justified by the projected revenue at prevailing prices. This means investment in new production capacity has been declining precisely when the world needs it most. Existing mines are not expanding either. The largest silver-producing regions, Mexico, Peru, and China, have seen production flatten or decline in recent years. This is not due to lack of effort. It is due to geological reality. The easy-to-access, high-grade deposits were mined decades ago. What remains requires more capital, more time, and higher prices to justify extraction. Meanwhile, above-ground inventories are shrinking. The COMEX warehouses in New York, which hold silver available for delivery against futures contracts, have seen steady drawdowns. The London vaults, which service the global precious metals market, report similar trends. Silver is leaving storage faster than it is being replenished. This inventory drawdown is masking the true severity of the deficit. When industrial users need silver, they can still obtain it because existing stockpiles fill the gap. But stockpiles are finite. They were accumulated over decades when production exceeded consumption. That era ended 6 years ago. There's also geographic concentration risk that few people discuss. Approximately 60% of global silver refining capacity is located in just 5 countries. China alone accounts for a significant portion. If geopolitical tensions disrupt trade flows, or if any major refinery experiences operational problems, the global supply chain has limited redundancy. The AI industry is placing unprecedented demand on a supply system that was already stressed before anyone started building ChatGPT servers. The mining industry cannot respond quickly. The refiners cannot expand capacity overnight. The geology cannot be changed through innovation or investment. Some analysts have suggested that recycling could bridge the gap. Silver is recyclable, and significant quantities are recovered from electronic waste each year. But recycling rates for silver are approximately 20% globally. Even if this doubled overnight, which is unrealistic, it would not come close to covering a 67 million ounce annual deficit that is about to grow substantially larger. The mathematics are unforgiving. If AI infrastructure deployment continues at its current pace, and if each new server requires 3.5 times more silver than traditional servers, and if mining production remains flat or declines, then the deficit will widen, perhaps to 100 million ounces annually, perhaps more. And when a market operates in sustained deficit, drawing down finite inventories to meet demand, there comes a point where those inventories approach depletion. When that point arrives, price is no longer determined by cost of production or historical trading ranges. Price is determined by desperation, by who needs the metal most urgently, by which industry can afford to pay whatever is necessary to secure supply. The supply side is not collapsing in a dramatic, visible way. It is eroding steadily, predictably, according to geological and economic forces that were set in motion years ago. But erosion eventually leads to collapse. And the AI industry is accelerating the timeline. There's a peculiar characteristic of commodity markets that most investors do not fully grasp until they witness it firsthand. Price and value can diverge for extended periods, sometimes for years, but eventually physical reality asserts itself. Silver trades on exchanges around the world, futures contracts change hands, derivatives are bought and sold, the COMEX in New York processes thousands of transactions daily. On paper, the market appears liquid and functional. The price hovers around $32 per ounce, moving within predictable ranges based on dollar strength, interest rates, and general commodity sentiment. But there are two silver markets, the paper market and the physical market, and they are beginning to separate. The paper market is where most price discovery occurs. Traders buy and sell contracts representing future delivery of silver. Banks hedge their positions. Speculators take directional bets. The vast majority of these contracts are settled in cash, not metal. They are financial instruments that reference silver without requiring anyone to actually possess it. The physical market is different. It is where manufacturers place orders for actual metal, where refiners deliver bars to fabricators, where semiconductor companies secure the silver they need to build circuit boards. This market moves slower. It operates on longer time frames. And it is starting to signal something that the paper market has not yet recognized. Premiums are rising. A premium is the amount a buyer pays above the spot price to obtain physical metal. Historically, premiums on silver bars and coins range from 5 to 10% above spot. In recent months, some dealers are reporting premiums of 15 to 20%. This is not normal. It indicates that demand for physical metal is exceeding immediately available supply. Industrial buyers are noticing longer lead times. Orders that once filled within weeks now require months. Refiners are operating at capacity. Delivery schedules are extending. These are early signs of tightness in the physical market that have not yet translated into significant price movements in the paper market, but they will. History provides instructive examples. In 2011, silver experienced a price spike that took it from $18 per ounce to nearly $50 in less than 5 months. The catalyst was not a supply disruption. It was recognition that demand was exceeding supply, combined with a surge in investment buying. When markets realize that physical shortages are real, price discovery becomes non-linear. The AI infrastructure build-out creates conditions for a similar dynamic, but with a critical difference. In 2011, industrial demand was stable. The price spike was driven primarily by investment speculation. Today, industrial demand itself is spiking. The AI industry cannot choose to wait for lower prices. Data centers must be built. Servers must be manufactured. Silver must be procured regardless of cost. This is demand inelasticity in its purest form. When prices rise, AI companies will not reduce their silver consumption. They cannot. The technical specifications are fixed. The only question becomes whether they can secure supply at any price. Modeling the path to $150 per ounce requires understanding how constrained physical markets behave. It begins with recognition. Currently, most market participants do not yet understand the magnitude of AI-driven silver demand. Analysts are not modeling it into their price forecasts. Mining companies are not adjusting production targets based on it. Investment funds are not positioning for it. Recognition will come in stages. First, supply chain professionals at technology companies will notice difficulty sourcing materials. Then, financial analysts covering semiconductor stocks will begin quantifying the silver requirement. Eventually, commodity traders will incorporate AI infrastructure demand into their models. As recognition spreads, purchasing behavior changes. Companies that previously ordered silver on a just-in-time basis will shift to securing long-term supply contracts. They will accept higher prices to guarantee availability. This removes supply from the spot market, tightening conditions further. When physical tightness becomes severe enough, the paper market loses its credibility as a price discovery mechanism. If someone holds a futures contract promising delivery of 5,000 ounces, but the refinery cannot produce it, what is that contract actually worth? This question has destabilized commodity markets before. It will do so again. The $150 price target is not arbitrary. It represents a level where several factors converge. At $150, previously uneconomic silver mines become profitable. Recycling intensifies dramatically. Investment capital floods into exploration and development. Most importantly, at $150, silver represents a cost structure that AI companies can absorb while still maintaining profitable operations. A data center costs billions to construct. If silver prices quintuple, it adds millions to the total cost. Significant, but not prohibitive. The projects will proceed, the servers will be built, and the silver will be purchased at whatever price is necessary. This is the mechanism that drives price discovery in physically constrained markets. It is not about speculation or sentiment. It is about companies with multi-billion-dollar commitments needing a specific input that cannot be substituted and is not being produced in sufficient quantities. The timeline for this transition is uncertain. Markets can remain disconnected from physical reality longer than seems rational. But the AI build-out is not slowing. The deficit is not shrinking, and inventories are not infinite. When price discovery occurs in earnest, it will not be gradual. Commodity markets under physical stress do not trend smoothly upward. They gap, they spike. They experience days where prices move 10 or 15% because someone urgently needs metal and is willing to pay whatever the market demands. The artificial intelligence revolution is real. The technology is transformative. The economic impact will be measured in trillions of dollars. But it all depends on building the physical infrastructure, and that infrastructure requires silver. At $32 per ounce, the market is pricing silver as if nothing has changed, as if AI servers consume the same materials as traditional servers, as if supply and demand remain balanced. None of these assumptions reflect reality, and reality always wins eventually.